Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Welcome back to the Ask Ralph Show. Now, we spent a lot of time at the beginning of the year talking about the new Tax Act, but now that we've gotten into the middle of the tax year, I thought it was a great time to revisit this since we still have a ton of planning opportunities available. Now, there was an article that ran on the nbsp personal finance website. It was written by a woman by the name of Darla Mercado. It was published on Wednesday, June 27th of 2018, and she really gives a good exposition of the benefits and what's going on with the tax code. So I wanted to spend some time talking about that. And what I want to start off with is the same place she starts off with, and that is right now is the best time to prepare. You know, this mid-year tax planning is especially important in 2018 because experts like myself say that their clients grapple with a volley of changes from the Tax Cuts and Jobs Act. And the truth is, the IRS is still working on some of this. And, but we need to think about these things. And the reason we need to think about that is it's a sharp limit in the itemized deductions, and there's an overhaul of the tax withholding that's going to apply to your wages. Not to mention the fact that there will be a new 1040. It's getting a makeover. I've been told it looks like a postcard with 6 worksheets filers will need to wade through in order to claim above the line deductions and credits. And we can talk about whether this is a simplification or this is, something more complicated. I frankly think the idea of a postcard is useless and a waste of time because, my opinion, most people are using software at this point to prepare their taxes. So it doesn't make a lot of sense to me to worry about this. But, it's all about appearances. And, we're going to make the code simpler because we're going to put it on a postcard. I just don't buy it because now you still got these 6 worksheets to climb through, and frankly, they're a little bit more complicated. So I see we're going to see more people going to accountants and tax preparers moving forward. You have to be prepared for your return to look a lot different than it did last year. It's not just the form themselves, but in terms of what's deductible and how your tax is calculated, this is totally different. So there are some key planning areas you should review with your accountant this summer. And I'm going to encourage anybody that's listening to this, if you don't have an accountant, you might want to consider, getting one. You're certainly welcome to go to my website, askralph.com, and we can certainly assist you. But now is the time to take a look at your tax situation and be prepared. Now, the first thing we want to talk about is withholding. And there's been a great deal of discussion about this. And I've mentioned this to a ton of my clients as they come in for their mid-year tax plan meetings. Just had one today, in fact. And my view is the IRS new tax tables have really overcompensated for the tax rate reduction. What do I mean by that? So, for example, I had a client in today, and this client, let's just say, generally gets a $5,000 year-end refund. Now, one of the things that I asked him, I said, well, tell me about your pay stub, from February and then now. Is there a big difference? He goes, well, yeah, Ralph, as a matter of fact, I noticed my federal withholding has dropped by $100 per pay. So I asked him, how many times do you get paid? He goes, every, twice a month. I said, so effectively, your withholding is going down by $200 a month. So if all things are equal, your withholding is now down by $2,400 for the year. So unless there is going to be a significant tax reduction for this person, I think this person is going to be looking at potentially half of the refund they usually get. And the problem is if you withhold too much, you get a refund next April. But if you're short, you're going to owe the IRS. And that could be a big problem for most people. It may have made sense for wage earners to withhold less under circumstances in the past if they were able to itemize, but now that they've doubled the standard deduction, it may not be a situation where you itemize and you could be in a position where you're under withheld. And that's why we're encouraging all of our clients to do a withholding review, especially if you've got a dual income household. And the best place to do that is if you go to irs.gov, they've got an IRS withholding calculator. Now, second issue, itemized deductions. And we talked about this a minute ago. The new tax code increased the standard deduction, but curbed many itemized deductions. Not the least of which is this $10,000 cap on the amount of state and local taxes you can claim and the outright elimination of miscellaneous itemized deductions like unreimbursed employee expenses and investment fees. So you need to sit down with your accountant and review your Schedule A, which is the itemized deduction schedule, and strategize. What is this going to look like in the current in the new tax year? One of the things that we've encouraged our clients to do is examine their property tax assessments and see whether you can argue those or ask for a challenge to be reduced. So if you're going to be close to that or above that $10,000 cap, if you can go to your county, your municipality and get that tax rate reduced, it might be a thing to do. And since fewer people will be itemizing, you've got to look for tax efficient ways to pay for things. So one of the ways that it mentioned in this article, I hadn't really thought about this, a great idea would be to use your health savings account to pay for long-term care insurance premiums if your balance is large enough to handle the expense. Great idea, because if you don't have enough to itemize, the medical deduction, especially for that long-term care, are not going to be deductible. Let's talk about investment expenses, because there's a big change in this area as well. In the past, you could deduct investment and custodial fees, trust administration fees, and other expenses for managing investments that produce taxable income. Now, of course, there was that caveat that it had to be over 2% of your adjusted gross income. But now those things are not deductible at all. You can't deduct them at all. So if your IRA, here's an example, IRA is a little bit of a nuance to this, but if your IRA is growing rapidly and you have a long-term horizon, you might consider using other money outside the IRA to pay these fees, since they're, you want to keep that money growing. But in general, you need to revisit whether your investment portfolio still makes sense and the fees that are being charged. Now let's jump to charitable contributions or charitable giving. If you're charitably inclined, but just short of surpassing that standard deduction. So if you're thinking about, okay, now as a married filing joint couple, we're at $24,000, one of the things you might want to consider is what we call bunching, and that's bunching deductions. And that's what you would do is consider making 2 years worth of donations in 2018 to get to the hurdle so you can itemize. So you may not make a donation in 2019, you're going to load them all in 2018. Now, one of the other things to do is to consider, if you're over 70 and a half and you're in that RMD situation, you might consider making a traditional IRA distribution directly to the qualifying charity. I have several clients that have done this. This move, known as the qualified charitable distribution, allows you to meet your RMD, so you're meeting your required minimum distribution, and your charitable goals at the same time. You won't incur income taxes on the distribution. So basically what I'm saying here is if you don't get a tax deduction for the gift because you're not able to itemize, you may as well do the charitable, qualified charitable distribution, because then you don't have to report this as income. So something that was, that you have to take as income. So the RMD is a requirement, but you can't take a deduction for the charitable contribution. And maybe you were going to use part of that RMD to pay your charitable contribution. The best strategy at this point now is to go ahead and make that distribution directly to the charity. Now, you need to talk with your investment advisor and find out, how many of these you can do per year. I know one of my clients was talking to me about this, and she said there's a limit to how often we can do these. So you may want to strategize on this. But if you are going to give that charity money anyway, it certainly makes a lot more sense to give them money that isn't going to cost you any income tax, especially if you're not going to be able to itemize. So again, just to bring this to some conclusion, it's a great time now to start your planning for tax time next year, but you've got to sit down with your accountant or your tax preparer and go over these things and make sure you're prepared. So I hope this was helpful.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware, and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.